Hello, how are you doing? Welcome along to FTUK's weekly catch-up live stream. It is Friday, the 16th of May 2025. Hope all is well with you, wherever you are, and whatever you have been trading over the course of the week. Interesting time in markets. Goodness me. The US-China trades war ceasefire thing, 90 days grace period, and boy, the market has enjoyed that one. That is for sure. Yeah, that S&P 500. I mean, it's not going to be long now before we're pushing back at all-time highs. It just shows you when the world is falling apart, there's always a buyer that comes in and steps in and just nails the bottom, and then that's it. And then, a few weeks goes by, and all of a sudden, we're pushing at the all-time highs again. I mean, what's that going to mean for the summer? Is it going to rotate up there and then fall back down again? I mean, it's difficult to work out right now, but it just shows you how difficult it can be to get a long-term position in that kind of volatility. Not easy at all. As always, please do join our Discord and go and speak to Reza. He will sort you out with all the latest information that's happening at FTUK over the course of the summer. And there's a lot to happen over the summer at FTUK. I can promise you that. Stuff I think that hopefully everyone is going to like. But today, we are doing in our live stream, I want to talk about a few interesting topics. I want to discuss consistency scoring. These are usually topics that are based on what people have been asking over the course of the week to our support team and stuff. So we're going to just have a quick recap. I want to show you why it is so important. We've got a video about consistency scoring that's going to be in the link in the description of the live stream, so you can head over and watch that. So we're not going to do too much detail, but I think we can definitely just discuss it in a little bit more of a broader fashion. I also want to then touch on some lighter things as well. Why different platforms name the products the way that they do. It's never consistent. That's one thing that's not consistent, is the way that liquidity providers and brokerages actually label their products, and it causes so much confusion. And I want to sort of demystify that a little bit and show you a cool little tip on how you can make sure that you never sort of like fall foul of understanding exactly what it is you are trading. And then finally as well, I thought this would be kind of a fun one to do, considering it's nice and warm and sunny in the middle of May, and that is look at some of the different nicknames for markets. We all have our favorites, and when you've started trading for the first time, you don't understand what someone's talking about. So yeah, we'll put some clarity around that as well. It should be good stuff. Right, let's start by talking about consistency. This is obviously a big thing for the prop industry now, and FTUK, we're applying it. You know, it's unpopular for some people, and a lot of other people don't mind it, but the traders that are getting used to working with consistency scoring, they don't have an issue with it at all, and they're proving that it can work really well. So that in itself is good to see. Now, what we're doing at FTUK is in the consistency scoring is not on everything. So if you really don't like the consistency scoring on your account, you don't need to work with it. It's as simple as that. We have a blend of lots of different types of accounts, so you can choose how you want to work. If you want the advantages that you can get by trading under the remit of a consistency score, then you can obviously benefit from doing that on the instant funding account. But the other accounts that we have, the 1-step and the 2-step, they don't have the scoring. So it's not like FTUK is, as a prop firm, is just doing this across the board. We give people the different options. So we've had some questions this week about consistency scoring, and it usually comes from people that they're finding it difficult to adapt into their strategy, and that's where the frustration comes from. There's a link in the description of this live stream, and that is takes you to the link that we put together that explains the whole mechanics of the consistency score. It's not difficult to understand, so we're not going to do a deep dive into the calculation. You don't need to. It's really easy. All you basically do is you take the largest day's profit that you've had in the cycle, and then you divide that by the total the total profit that you've had on the account over the lifetime. And what that does is it gives you a decimal. You multiply that by 100, that gives you a percentage score. And what happens is you are eligible for various different things at FTUK if you're able to keep your score under the threshold that we set on the account. On instant funding, at the moment, that is set at 20%. And a lot of people, that seems to be about right in terms of getting the kind of balance in equity that we're looking for versus the amount of people that can, work with it and they have no issues on passing their accounts, getting the payouts, all of that kind of stuff. So it does seem to be working quite well. That's an example of how that looks. This is all in the video as well, so you don't need to worry. You can go through this in your own time if you want to look at the video. So you can see in that example there on day 3, the largest profit there on the cycle in the account was $200. You divide that by the total profit on the account, $420. That gives you 0.476. Multiply that by 100 to get your percentage, and then you've got your score, 47.6%. So on that particular one, that would not be that would need to be lower to then qualify to be under the 20%. So what you're really essentially looking at is you're looking at the difference between the average profits that you're getting versus the outliers. And what that does is it compresses the equity curve like that. And that's what we're looking for, because what you see there, this is almost like the perfect kind of equity curve. And this is real. This is someone who passed an account, got the payout, and was able to work consistently with their strategy, with the market volatility, to create a really beautiful looking equity curve, because it's very, very balanced from a risk point of view. There's no erratic volatility in profits and losses, and big swings. So it is something that is highly possible. Now at FTUK, what happens is there's 2 core things that happen if you are able to trade consistently. You can get your payouts on demand. That's the first thing. So to get your payout, you need to be consistent, and you can get it on demand. And then also as well, that then qualifies you for scaling. So it's a very, very easy way of saying, yes, this is someone who can handle the risk, they can manage their account effectively, and we have no problems in giving them a funded account and then just seeing where we go from there. What it's doing is it's essentially promoting better risk management. Now, someone will say, yeah, but it's a $5,000 account. Yes, it is on the instant funding, or it's a smaller account, a 10K account, whatever it is. Yes, you could say, well, it's debatable how risky that is. But what you've got to remember that at FTUK, we are very, very aggressive in scaling. So it's not long before someone starts to get up to those bigger levels. Once you get up to there, the swings in equity from the position sizes on those sizes of accounts, it really gets aggressive. So you need to find people, you need to have people that can behave like that, because that makes no difference when it's sort of, $100, $200, $300. But as soon as you then get that person scaling up and that becomes, $200,000, $300,000 or whatever, it really makes a big difference. And that's you showing you the skill that someone has in being able to handle that kind of an account with that kind of firepower to produce something that is consistent in the market. Now, one of the good things about the consistency score, in fact, actually, this is one of the good things about the prop industry, which I absolutely love, and no one ever gives the prop industry credit for this, is the one thing that the prop industry has done is it is creating a generation of traders who think risk all the time, which is one of the absolute hallmarks of someone who is good at investing in general, someone who is always thinking of the downside risk. Yeah, the brokerage industry in itself, the retail brokerage industry, if you're willing to take your 10 grand of savings or your 5 grand and just stick it in, they'll give you 500 to 1 leverage, sometimes 1,000 to 1 leverage, and they don't really mind. As long as they've protected their bottom line, they'll let you blow that up, no problem. Yeah, how is that good? How is that good effective? So one of the good things that the prop industry does, and we see all the time in the successful traders that are passing the accounts, is they're able to think in terms of not only market analysis and profitable strategies and where their edge is, but they're always thinking of the downside risk. And this is the one thing that is really, really good about this industry. And it will ultimately, in sort of 5-10 years, because the prop industry is growing, it will always breed better people that are better investing. And I cannot see how that is not a good thing. So so this is essentially what we are trying to avoid. Now, what's wrong with this situation? So say, for example, our target is up there that someone is looking for to pass the account or looking to scale. Yes, they did hit it, but look at the way that it was. Look at the journey that they went on. Look at the drawdown. Look at the amount of times that they go drawn down. I know this is hypothetical, but it illustrates a really key point, and that is right at the worst point of where they were nearly hitting their drawdown level. They were actually in the same position here at the early on in the account as they were right at the very end. And they only then achieved the actual equity that was required right at the end of the process. Now, is that a problem? Well, no, it's not a problem in the sense that, yes, they did do it. But like I said, you start to scale someone like that, you've got to start to ask yourself, okay, is that consistency? Is that someone who's able to replicate that over and over and over and over and over again? I would say suspect not. Because once you apply leverage to that kind of thing and extra firepower, it's you're going to blow up eventually. And you're going to do it quickly, because look how fast the actual profit on the account was created. And that could also be someone just loading up into a non-farm payroll. That could also be someone who just happens to be on the right side of gold at the right point and just launches straight into it. Was that skill? Is that repeatable? So my question is, would you describe that as being good trading? Well, you kind of got there, but from a consistency, repeatability point of view, and that's what prop trading is all about, consistent traders that are able to demonstrate that they can do it over and over again. And it's not just luck. It's not a gamble, and it's not just luck. No, so in that sense, no, it's not. Now, you're obviously, the people that really sort of don't like this, obviously they're free to take their own funds and open a retail brokerage account where you're not going to have these problems. But I absolutely guarantee you, if you work with the consistency score and you take your strategy and you figure out how to apply it properly, you will become the smartest guy in the room. You really will benefit as a trader because you can handle anything. You can handle a market crash. You can handle the volatilities that we've got in the stock markets, or the dollar, or whatever it is, or a Bitcoin thing. Because you are completely unfazed by that, and it doesn't affect your equity, doesn't affect your mindset. You are a consistent trader. You see how that creates a very positive feedback loop? So yeah, it's a good thing. I like it a lot. It does the job. Let me show you an example of, this is obviously a hypothetical thing that we had drawn out on a graphic, but essentially what that looks like in a real account. This is an account from relatively recently. This is the same thing. Can you see how the majority of the trading on the account, and it doesn't matter whether that was 3 days or 6 months, but the majority of the trading on the account, I mean, it sort of starts to work, but then there's quite a deep drawdown, but then suddenly Suddenly, one trade at the end just launches the account forward and pushes it past the post. Oh, that's great. That's wonderful. But eventually, you will then end up on your next account where you don't have that luck. You don't have that opportunity. And that therefore means that the performance on the account beforehand, however that was done, will eventually grind down to a drawdown point. And then, okay, well, that's it. You've blown it up. Yeah. So it's like a gear on a bicycle. You know, you're just missing the cog all the time and you can feel that kick. That's what that kind of stuff actually represents if you keep doing it over and over again. So that's what we are wanting to avoid. So you'll see there on the graphic, the consistency score, that is 100. It should be 20. So it's too high. In fact, it's over 100, which is why it's red. So once you start to trade in a way that it becomes more consistent, it starts to come down. You get under 20% and all of a sudden you've got that kind of equity curve, which is nirvana. That is what everyone is looking for. That's how it works. It's an interesting topic. I think it does a good job for the industry, though. So, yeah, those that embrace it and have figured it out how to work with it are they're doing well. They are doing well and they are successful, and that's good to see. Let's move on. Let's talk about different names of products, because this is not consistent, and this, unfortunately, this is not something that we have any control over or any say over, because we need liquidity providers as well, and it can be a bit of a mess. And I think as an industry, the brokerage industry should sort this out. But I want to unpick it a little bit. And this is because we have a lot of questions of people that can't find stuff in the platform, and they're used to using it somewhere else, but it was called something different, and they search for it and they can't find it. What's going on? So you recognize all of these names on here: NASX, NAS 100, US 100, NQ, NASQ. Obviously, that's referring to the NASDAQ. So it's a blend of various different ways of arriving at the same destination. So that's a relatively obvious one. But it's still, you'd be surprised how often people get confused. And they do actually think, well, I was trading US 100 at my last firm, and now I can't find it. So where do I find the US 100? And some people will even approach it and they're like, I didn't even know it was the NASDAQ. They're just used to trading that specific thing because that's what it's called. And we're all creatures of habit, yeah? So it is labeled differently in different platforms. And, you will find that from the platforms and the different liquidity providers, prop firm to prop firm and brokerage to brokerage. What about US 30 or the DJ 30, the Dow Jones, or the DJIA? I've seen all of these in trading terminals before, and they're all labeled like that, but of course they all refer to the same thing. And that is the Dow Jones Industrial Average, which is one of the older stock markets out there. So you do find that it is labeled differently. US 500, S&P, SP 500, S&P 500, SPX, USPX. These are all things that we've seen in platforms before, and it does cause a lot of confusion. And it's the European one as well. Euro 40 is also the Euro stocks, and they put several X's at the end of it for some reason. Lots of different ways of labeling it. It's the same with the UK 100, the FTSE, and then even crude oil gets a bit of a lashing in this, and I've seen it called different things. US oil, WTI. Obviously, you got Brent as well, but that can be very, very confusing if you're not sure if it's Brent. Or you're not sure if it's US crude oil and you're not sure which one to trade. Yeah, it's not. I get it. It's not easy to figure out. So what's actually going on? Well, it all revolves around pricing, because ultimately every prop firm, every liquidity provider has to get their pricing from somewhere. So it has to come from some bit of the inner system, and you really split that in half. On the FX side, and this is why we don't really have these problems in FX, and that's because the pricing for the FX markets, which is a spot market over the counter, it's not centralized, but essentially six large commercial banks in the city of London. I forget specifically which ones. I think Barclays is one of them, Citibank, I think Deutsche is in there as well. They essentially, their price at any point in time for a foreign exchange transaction, a bid and an offer on any FX rate, they get amalgamated together, and that is what comprises the FX markets. And then the liquidity providers take that, wrap the spread around it, that kind of thing. But everybody knows it's just the euro against the dollar, or it's the dollar against the yen. There's no discrepancy in there. It's a little bit different when you start to look at indices and commodities. So for things like indices and commodities, they have to be based around the prices that come out of the centralized exchanges on which they trade. So things like on the CME, you'll see all of the futures and options for the various different products. And one example of that, let me just quickly show you, is the, let me just get it up here on my screen, is the copper market. So if I just go over there, there you go, you can see it here. So this is the page on the CME that handles everything to do with the copper pricing. So you'll find that within any platform, see this is the last prices for the May contract that you've got on here. But all of that information, and it's not just the price, it's time and sales, it's market depth, it's all of the various contract information and stuff like that. It's all, and the volume as well, and of course the open interest as well. That is all baked into the information that's traded on the exchange. Well, here's the thing. What tends to happen is that exchanges want to charge for the information. They want to charge for the information to charge for the data. So if you're a brokerage or a prop firm or a liquidity provider or some sort of a third party that wants to offer trading products based around copper for retail circles, for the prop industry, then you're going to have to pay for your data one way or the other. Yeah. So from the exchange point of view, that's a source of revenue for them. So they want to sell it. And that is really the problem. That is really the sticking point. And usually what you find when the industry is making money in a particular direction is that all the rest of the participants, they look for loopholes, they look for ways to save money. Yeah. So there's a tendency for, because this stuff is recurring and it can be expensive as well, brokerages will look for a lot of loopholes to basically sort of like bring down that bottom line to make it more cost effective. And it's more expensive to use the product itself when you use all components of that. So you'll find that what the exchanges do is that they have hierarchies of levels of service. So maybe you don't get the volume, you don't get the volume, you don't get the open interest, you don't get the all of the other bells and whistles around it, but you do just get a price feed. But there's restrictions on what you can do with that, yeah. But it's a bit cheaper, yeah. So they do that, but that probably then means one of the core things is that they can't name the products after what the exchange calls them. So you can't keep it simple. So what the industry does is it goes away and it relabels it. And that is one of the reasons why, I don't know if it's the only reason, but it is one of the reasons. So what they'll do is they'll get that information, that price feed as a cheaper cost for the business. They'll wrap their own information around it, their own spread and everything, and their own swaps or whatever, and then they'll rename it. And that's why you get this variety across all of the different platforms. And it is so confusing, but it's all, at the end of the day, it's all about money. Now, what can you do to sort of maybe fix this? Well, there is one thing that you can do. It's not difficult to do, and once you know it, it's blindingly obvious. And that is, if you've moved to another prop firm, or if you come to FTUK and we've got it labeled in a slightly different way, all you need to do is look at the price. It's the price that never lies, yeah? So go to a daily chart, go to a weekly chart, go to TradingView or wherever you were before, and just double check the price. Open up a big picture time frame and look, and you'll see very, very quickly, okay, well, they've called it NAS 100 there, and it was US 100 here. I know I'm trading the same thing. You know that you're then dealing with the right market. And it sounds so obvious when you know, but you'd be surprised how many people don't know. And I know that because so many people write in every single day that can't find these specific things that they want to trade. So it's it's one of those things. The industry should clean it up. But to be honest with you, all my years of trading as well, it's always been like that. So until things change from an exchange point of view and the pricing is adjusted, you'll probably find it's always the same. But it's a very simple workaround for sure. Right, let's move on and talk about the last topic. This is kind of a fun one. Nicknames for markets. They exist. They exist. And you may have come across some yourself, or you may have been on Reddit or some forum and seen someone refer to something as something and you were completely confused because you didn't understand the local knowledge around it. Yeah, some of these names have been around for a long time. It's based on affection, based on some sort of other reason, slang, whatever you want to call it. But it's kind of fun, and I put together a list of some interesting ones, and I thought I would struggle. I thought I would only be able to come up with one or two, but I found more than I thought. And I don't tend to refer to them like this, but it is a very popular way of doing it. So we'll go through a few of them. Most of them are FX based, but we have got a few market ones as well. First one is cable. That is probably the most well known. And it refers to the pound against the US dollar. And it's kind of like, well, why on earth are you calling an exchange rate cable? And it's because before we had the internet, before we had proper sort of like trading systems and stuff, and they started to put cables to connect the United States with the United Kingdom on the globe, got connected through by laying cables on the bottom of the ocean. That's how prices were transmitted. I mean, we talked last week about the reminiscences of a stock operator. Read the history behind this. It's where you get your ultimate confidence and competency from, because the history of markets is absolutely fascinating. So they laid the cables down, and of course they could then transmit prices over the wires, which is why they said the news over the wire, across the Atlantic, back and forth, so that in New York you could know within a few minutes or whatever what the current market price in London was for the pound against the dollar. And of course that information was coming across a cable, so it got affectionately known as the cable. And to this day it is still called cable. Of course it's a little bit different, a little bit more high tech than that these days, but that is the reason why it was called that. And then another one which is very, very similar to that is, let me bring it up, is this one here. And that's the modern day equivalent of that. And when because the euro is not a very old currency, it's one of the newer ones out there. And this got known as the fiber, because obviously technology has moved on. So this is like your internet version of what cable was. So and that's literally all it is. It's got nothing to do with Europe itself. It's just to do with the way that people name things. So you got the cable from the UK, that's the old-fashioned one, and then the euro is the new one. So we'll upgrade cable to fiber, because it's over a fiber network or an internet cable. So yeah, it's the cable for the internet generation, which is interesting, but it's got nothing to do with trading in itself, which is kind of weird. What about this one here, the FTSE? I mean, this is quite an obvious one. This is really just a reworking of the actual name itself, because obviously FTSE comes from the Financial Times Stock Exchange, and the Financial Times Stock Exchange Index is obviously created by the Financial Times journalistic newspaper. And that's where it was based. But if you then string the acronym together, it kind of looks like FTSE. And that's it. And to this day, you'll see it written like that as well, FOOTSIE. So it does get labeled as FTSE quite often as well. And again, that doesn't really have anything to do with the actual trading, but it's just the naming convention of why it ended up with that name. And it's got to do with the way that it looks on the page. What about this one? I've heard this one. This used to confuse me a lot when I started futures trading a long time ago in Canary Wharf. And these guys used to say, "Oh, we're going to talk about the SPOOs next. How did you get on the SPOO yesterday?" And I'm like, "What are you talking about?" And what they refer to the ES, the E-mini S&P 500 futures contract operating on the CME. And that is basically because the S&P 500 is one of the biggest benchmarks. Obviously, S&P is an index, but S&P refers to a rating agency. It's a Standard & Poor's rating agency. They have their own index. It's a balance of 500 companies in the US, and that got created into the S&P 500, which people look at. It's a benchmark in the industry, and then obviously the industry then comes along and it creates tradable products around it. One of those being the E-mini, the S&P 500 futures contract, and then that got shortened down to the word SPOO. So if you ever come across that, and you will see it, it's not as maybe it's one of those is slightly fading a little bit, but particularly that futures prop trading is now becoming more and more popular, so it might get a massive resurgence, and you'll go onto a forum and see people talking about trading the SPOOs, and that's what it refers to, the S&P 500. Next one here, this one is one that I wouldn't use myself, but it is there. You will find it somewhere online, and it's called the Channel. And this is a geographical one. This is to do with the connection between Europe and the UK. There's one connective tunnel. Obviously, the Channel Tunnel is a great feat of engineering in the 80s. That connects Europe and also the United Kingdom. So, for an exchange rate point of view, the euro against the pound, some bright spark came up with the idea of calling it the Channel. I've not seen much of it. I have seen it once or twice, but it is a thing. So if you want to sound like you know what you're doing, I'd probably just call it Euro GBP. But yeah, channel, you can go down that road if you so choose to. Next one, this is where you start to bring in some animals as well, and animals are popular mainly from a nationalistic point of view. I could find 3. There may be more, but I could find 3. First one, and this is the most obvious one, and that is the loonie. This is the US dollar against the Canadian dollar, and what tends to happen with some products is that they take some sort of a national emblem, some sort of a national symbol, and then that gets wrapped into a name. And of course, there's a bird called the common loon, and that is one of the national native birds of Canada and certainly North America into the northern hemisphere. And yeah, so the affectionately the Canadian dollar against the dollar is named the loonie. You'd think it would be more commodity based, with crude oil based or something like that. But no, they called it after a bird. So yeah, if you ever hear that term, you know that you're talking about the US dollar against the Canadian dollar. Next one as well, again, this is another bird as well. On the opposite side of the world is the kiwi. This is one of the national symbols of New Zealand, the kiwi bird. There it is there. Got nothing to do with currencies other than the fact that the New Zealand dollar is the national currency of New Zealand. So yeah, you this is very, very common. You will see it everywhere. People say I'm trading the kiwi today, and what they're really meaning is the New Zealand dollar against the US dollar. Now, whether there's any sort of follow through and they say that refers to the New Zealand dollar against anything, I don't know. I would traditionally read that as being connected between the New Zealand dollar and the US dollar, but you never know. These things there's no rule book with this kind of thing, so it's interesting how people carve it up. The other one that I've got, which I think is, the last one that I've got, which I thought, and I think that maybe some others, and if you know any others or you've thought of any others, write a comment. I would be really, really fascinated. This is not a clickbaity sort of thing, but I would be fascinated to know if you know of any other names for any other markets, because I love this kind of like historical detail, the knowledge around this stuff. The last one that I've got though would be the dragon, and this is something that a lot of our guys trade as well. This refers to the pound against the Japanese yen, and it really comes from the Japanese side of it, because of the way that some of the symbols in Japan work, and China as well, or that part of Asia, and the dragon is a big national symbol used in carnivals and all that type of stuff, Year of the Dragon, stuff like that. It's a big thing, but yeah, for some reason that has found a connection with the pound against the Japanese yen, and it's stuck. And it could also be as well because it's a violent market as well. It's a very, very thin market. It can be up or down 200 pips in a whisker. So it's probably one of the most thinnest, most unpredictable markets, and it's very, very popular because it's very, very volatile. So you could argue maybe a dragon is slightly volatile as well. I don't know, maybe. What do you think? Kind of interesting though. Yeah, so there we go. That's a sweep round. I think that was seven or 8. There's probably 1 or 2 more out there, but yeah, like I said, if you have got any names for them, then yeah, I would be really interested to know. So please leave a message and let me know, and I promise you I will reply. Right, okay, so that's it for today. Other than to talk about our weekend offer, obviously the United States and China have sort of put the trade war to rest for a period of time, 90 days in total so far. Markets are loving it, and it's important. It shows you how connected the geopolitical situation is to the volatility at the moment. So as a consequence of that, we've got an offer at the moment. It's a bigger discount this week. It's a 30% discount off all of the accounts. You get an extra 2% drawdown on level 1. Let me just write that on there. On level 1 for the instant funding accounts with this offer as well. And also as well, we're going to make a change for the weekend. So it's a kind of like a not a flash sale, but a mini boost, a mini flash boost or something like that. And that is what we're going to do because the news is so important at the moment. On the challenge accounts, you get a BOGO, so you get a free account after you get your first payout. So it's essentially a 2-for-1 offer. But we're also going to throw in for this weekend, we're going to throw in the news trading add-on, which is something we never ever do. It's because it's so important at the moment. So if you are looking to get hold of a decent prop account and you want to start connecting what's happening in the world with the volatility in the markets, then the news trading add-on is definitely something that you can benefit from. So check it out this weekend. 30% off all accounts, 2% drawdown on level 1 on instance, and then also BOGO challenges, and you get that news trading add-on thrown in there as well for free. Really good stuff. That was quite an interesting one. A little bit lighter. It's nice. It's nice doing things a little bit more, a little bit more lighthearted. And the context behind markets is absolutely fascinating. I absolutely love it. That's everything that we've got for today. Thank you very much for joining us. Have a fantastic weekend, and we will see you all next Friday.